So the 4% rule, also known as the Bengen rule, is a rule developed by Bill Bengen in the US in 1993. And he really wanted to check out what the safe withdrawal rate was. So using a lot of historical market data, he determined that the 4% rule was the safe withdrawal rate. So what he meant by this was taking out 4% as an income each year should hopefully prevent against something called longevity risk. So that actually after 30 years, the probability was about 95% probability that you would still have money left in the pot. The one misconception that people sometimes forget or ignore is that actually it's not 4% every year, it's 4% from the initial value and then goes by inflation after that.
Sequencing risk.
So sequencing risk is a real danger. It's a real danger for retirees because it is actually also known as a sequence return risk. So what this means is that if your sequence of returns is very negative at the beginning of the withdrawal stage, this can be really detrimental to your pot, and you could actually end up withdrawing money at the wrong stage because you're not allowing for any recovery from your capital because you've actually withdrawn it after a poor patch in the markets. So it can be very damaging indeed. And actually, if we think of an example, you could have two very similar portfolios or identical portfolios, both with an initial value of 100,000, withdrawing 5,000 each year. And if you had a different sequence of returns, yet the portfolio itself had the same arithmetic return, the same standard deviations, the same volatility, it could actually end up that one portfolio could run out of capital within 13 years, and the other portfolio could actually double by the end of the 30th year. So it's all about when the sequence comes. And what we're really talking about is the difference between arithmetic returns and geometric returns. So we're in a really interesting market environment at the moment where yields on fixed income are very low, which really means if we think of kind of a typical portfolio, which might be a 50-50 blend between equity and fixed income, that really isn't that appropriate these days for an income portfolio. Previously, that might pay you 4 or 5% each year, but actually where yields are today, that really pays you more like 2%. So for people wanting income, the real problem is that they're actually having to go up the risk spectrum. They're basically having to really invest much more in equities because that's where the income's coming from. Now, of course, with that is, if you tie that back into the sequencing risk answer, is actually absolutely the danger that they end up in a higher volatility type asset class, which we're withdrawing, which then could really damage their returns. So it is all about taking on actually probably too much risk to try and seek out that income. That's where the real risk lies in today's environment.